It's been an exciting 12 months. We speak to a lot of the debt funds. Probably 12 months ago, we had 20 direct lending relationships. From an advisory perspective, I'd say we now have 35. So it shows sheer volume of money that's coming into the market. I do think it's more of a product for the mid-market and the leverage market rather than the larger corporate play. We're seeing a lot of liquidity coming into the market, but to some degree that's just replacing bank financing. I wouldn't say it's particularly driving lending volumes up. I think net it's broadly stable. I would probably say mid-market PE get the product, really understand the value of it. I think as you move up the scale and you get into larger corporates, it's probably not on the radar. I think when you actually look at who's taking the capital up, probably there's a degree of suspicion, skepticism as to what it means for that company, for that portfolio. But I think investing the time to really understand the product, we're seeing it deployed. Businesses like Trainline, businesses like the University of Law, which was the College of Law, have really used the product well and to their advantage. I think the main benefit probably is businesses that are growing quickly, and I think if we see, and I'll be touching on this a bit later on, economic growth is coming through. We're seeing companies actually getting back into growth phase and really wanting to retain their cash flow, not for servicing debt, but for actually growing the business and delivering equity returns. So I think for me, the fact that the product is generally non-amortizing, it's a bit longer dated, you can get a direct investor relationship, flexible covenants for the business. I think that's all great. I think probably on the negative side, yes, it's more expensive because it's a trade. You're getting those benefits, and the other thing is, depending on the life cycle of the business, it can be expensive to prepay.